So way back in 1789, Ben Franklin said, "Nothing is certain except death and taxes." Well, today I'm going to tell you about one way that Mr. Franklin was wrong, about taxes anyway.
Whatever.
Today we're going to look at how you can use a health savings account to save, invest, and even spend money that is never, ever taxed. So what is a health savings account? A health savings account is a tax advantage saving and investing account designed to help you save for medical expenses. HSAs are the only account that enjoy a triple tax advantage savings, meaning any contributions, earnings, and withdrawals from the accounts are completely tax-free if they're used for a qualified medical expense. There is no other tax advantage account that allows you to save, invest, and withdraw money completely tax-free the entire life of the account. So for those of you who remember back around 2010 when the Affordable Care Act was being pushed through Congress, you might recall the cost of health care was somewhat turbulent. Now, up until that point, I was in my late 20s, and for years my wife and I had enjoyed the Cadillac insurance that was provided from my employer. Since it was just the two of us, the deductibles were pretty low and the cost really wasn't that bad either. So when premiums began to skyrocket, I started looking around at what our options could be to keep costs down. That's when I learned about high deductible health plans and health savings accounts. Now, to put it succinctly, basically a high deductible health plan is exactly what it is. It's a health plan that has a high deductible. In other words, the owner or the insured carries a higher degree of risk because their deductible is higher. So for smaller medical expenses, say you just have an illness and you go to a doc in the box or some other sort of mild treatment, you're going to pay for most of that out of pocket because your deductible is much higher in a high deductible health plan. But generally speaking, you're rewarded with lower premiums because the risk is much lower for the insurance company. So for example, in 2024, a single person will pay $1,600 in deductibles before their insurance kicks in a high deductible health plan. Now, obviously, this is a better deal for insurance companies, but it also leaves you with a higher degree of risk. Well, to help mitigate that risk, in 2003, health savings accounts were invented to completely relieve the tax burden on medical expenses. Let's walk through some of the benefits of HSAs so you can see how they might be helpful for you. All right, the first and primary benefit of HSAs is the ability to make contributions, to invest those contributions and generate earnings, and then the ability to withdraw all of that money completely tax-free if it's used for a qualified medical expense. That means if you spend the money on a qualified medical expense, the money in an HSA is never taxed, ever. Like we said at the beginning, there's no other account that enjoys that sort of tax-favored treatment. A secondary but closely related benefit is that if you contribute to an HSA through an employer-sponsored plan, those dollars are placed into your HSA before Social Security or Medicare taxes are withheld. So in a way, it's like a triple tax advantage plus two more through an employer-sponsored plan for, what is that, a quintuplet advantage? I don't know. Now, Social Security and Medicare taxes represent 7.65% of your income, so it's not an insignificant amount of savings. Generally speaking, if you can do an HSA through your employer, that's a good way to go. A third benefit of HSAs is all contributions are yours forever. Unlike an FSA where you put money in and you have until the end of the year to use it or you lose it, an HSA stays with you for good. That's true even if you change employers. So if you have a balance at the end of a tax year, it just rolls into the next year. If you leave the employer you're with, your HSA goes with you. It becomes yours forever. Number 4, when you reach age 65, any money in the HSA is available for withdrawal penalty-free. Now, if you make withdrawals for anything other than a qualified medical expense before you turn age 65, there's a 25% penalty, which we'll get to more in a minute. But after age 65, you can kind of use it like a tax-deferred retirement account, like a traditional IRA. You do pay income tax on those withdrawals, but there are no penalties. So in a way, it becomes a secondary retirement account. The great thing about this is you don't have to sweat if you over-contribute to an HSA. One day, you'll be able to get the money out and actually use it in retirement for anything you want. Yes, you'll pay income tax, but at least you have the flexibility to use it for something other than a qualified medical expense. A fifth benefit of HSAs is the ability to invest any contributions you make to the account. So the tax advantages of contributing and withdrawing money from an HSA are great, but the fact that you also get to invest that money and any earnings are also completely tax-free when used for a qualified medical expense is just a huge, huge advantage. And like we said before, the ability to make withdrawals beginning at age 65 makes it like a secondary retirement account. So much so, in fact, that I would argue you should possibly consider using an HSA first when making retirement contributions because 401ks and IRAs don't potentially get that triple tax advantage. Now, with that said, it does depend a bit on your personal circumstances. Obviously, if you have an employer match or employer contribution that's completely free, you should take that free money first. Now, there are some circumstances where an employer will actually make contributions to an HSA. That's actually the circumstance where I work. So every year, I'm sure to sign up for the HSA and get the free employer contribution, and then I also take advantage of my employer's contribution to my 401k. But if I could only pick one, I would take the HSA first. All right, HSA eligibility. Not everyone can contribute to an HSA. The first requirement is that you be enrolled in a high deductible health plan, or HDHP. Now, instead of reading out the qualifications for a high deductible health plan, we've got them listed on your screen. As you can see, the deductibles are generally higher than you'll see in most PPO plans. You also should pay attention to that maximum out of pocket. If you have a major medical expense, chances are you might actually reach that in a year. So that's something you need to keep in mind before you sign up for a high deductible health plan. Now, to summarize, that deductible means you'll pay 100% of every cost up to that amount. Then beyond that, your insurance will step in. A lot of times that's called co-insurance, or they'll step in and kind of pay part, or usually it's like 80 or 90% from that point on until you reach your out-of-pocket max. And when you reach the out-of-pocket max, your liability is capped and the insurance company steps in and pays for the rest. You're also not eligible for an HSA if you're covered by another health plan in addition to your HDHP. You're covered by Medicare, or you're dependent on someone else's taxes. Even though HSAs are a great place to save money, there are limitations on how much you can contribute each year. The amount actually varies depending on if you're single or if you're married with kids and who's covered by your plan. In 2024, if you're single, you can contribute up to $4,150. And if you're under a family plan, you can contribute up to $8,300, and there are no restrictions based on your annual income. As you make contributions to your HSA, keep those high deductibles in mind. It's probably wise to reserve at least some portion of your HSA and leave it in cash instead of investing it all. That way you can cover those deductibles if you do incur a medical expense. And if all your money is stuck in investments, it may not be the best time to sell those in order to pay for those expenses. So if you incur a medical expense when the market's in a bit of a dip, that wouldn't be the ideal time to sell those investments in order to pay for a medical expense. It's better just to have it in cash or cash equivalent. That way the money's there when you need it. This is exactly why many plans will require you to keep at least some portion of your balance in cash all the time. Of course, if you have a properly funded emergency fund, this is less of an issue, but it's something to keep in mind nonetheless. All right, so where to open an HSA? Well, if you have one through your employer, that's probably the way to go. If the plan at your employer is just full of really terrible, awful, expensive investments and you just really don't want to open one there, you can open them at really any large brokerage company in the country. They all generally offer a wide spectrum of investments that you can choose from. In the past, I've actually had HSAs with different companies like Fidelity and Vanguard, and I had no issues. It was really easy to use, so finding one shouldn't be a problem. Now keep in mind, if you go to the open market to open an HSA, all your contributions will be made with after-tax dollars. You will get a deduction for those contributions, but the Medicare and Social Security tax that was withheld from your paycheck will still be withheld. You can't get that back. So that's a small benefit you kind of lose by not using an employer-sponsored plan, but don't let the tail wag the dog. If you want to do an HSA and you don't have one through your employer, just go open one with another brokerage firm. I also want to talk about a more sophisticated approach to using an HSA. So mathematically, it makes more sense to leave the money in the HSA as long as you possibly can. Now you can do this because expenses in an HSA are reimbursable at any time. There's no limitation on it. So if you have a medical expense, say in, 2023, you can wait indefinitely to seek reimbursement for that expense. All you need to do is save the receipt, keep it on file, then one day go back and pull that money out. In so doing, you allow that balance of money, let's say the bill's $1,000, you allow that to continue to grow within the account, triple tax advantage, tax-free, and build the value of the account larger and larger. There are a lot of people who contribute to an HSA and then never use the money for a medical expense, or at least don't until years and years down the road because they want to leave that money in the account. But like I said, you need to keep up with all the receipts for those medical expenses. And that's exactly why I usually don't do this. Just last week, I had to go to the pharmacy and get an antibiotic for my son. It was $3.94. Granted, I could have left that $3.94 in the HSA, but I really did not want to keep up with a receipt for $3.94 for years to come. You might want to do that, and that's fine if you do. There's no right or wrong here. I'm just telling you, mathematically, it's optimal to leave the money in the account as long as you can, but it's also a lot of headache. All right, so how to evaluate the best option for you? Well, to evaluate whether or not you should sign up for an HDHP and an HSA, you'll need to know a few things. The first, I would say, is your medical history. Are you a person that's in good health? If you have expensive pharmaceuticals or drugs that you have to take every year, an HSA may not be a great option for you. Also, if you're going to the doctor for treatment for some ailment that's, just won't go away or is ongoing, or maybe you're just going to be living with it the rest of your life, it may not make sense mathematically to do that, but you're going to have to evaluate that yourself. A big part of that, again, like I said earlier, is to run down your old insurance company costs each year, how much medical expense you actually incurred. Try to get that information if you can. It could be really, really useful as you make plans to use an HSA or HDHP in the future. The next thing you need to evaluate is how much you'll actually save in annual premiums between a PPO and an HDHP. This can vary wildly depending on where you work. I've actually seen places where the employer offers no incentive whatsoever for you to sign up for the HDHP with the HSA versus the PPO or HPO, whatever the higher dollar insurance is. So you can't just take it for granted that the HDHP is going to be the cheaper premium value. You should also factor in any contributions your employer makes. Basically, you want to take every possible advantage and calculate the delta, the cost delta between the PPO, Cadillac, HPO insurance, whatever you have on this side, and your HDHP, how much you're actually going to save, and then evaluate the risk. Is it worth shouldering more risk to pay less in premiums each year and to save that money in HSA, or should you just stick with what you got? And all that is going to depend on the terms of your plan, where you work. It's going to depend on how much your employer is actually willing to contribute to the HSA. It's going to depend on how much the premiums are. It's going to depend on your medical history. There's not a one-size-fits-all answer, unfortunately. But the good news is we are recording a video where I'll explain how we made that evaluation ourselves. Like the complete nerd that I am, I made a lot of spreadsheets. I factored in a lot of different things, and I'll show you how to do that. I'll put a link to it above and in the description below at the end of this video. Another note about HSAs is that they don't make the greatest inheritance. I don't see this talked about very often, but in a lot of cases, say you have assets, for example, that are in taxable spaces. Let's just say a stock in an investment account. If you leave that to your heirs, they get a free step-up in basis for the value of that. If you leave a house to your heirs, they get a free step-up basis for the value of that. If they inherit an IRA, they have to make required minimum distributions or liquidate the account within 10 years. If it's a traditional IRA or 401k, they're going to pay an income tax on those withdrawals because they've never been taxed. If it's a Roth IRA, they get to make those withdrawals completely tax-free. But for an HSA, your heirs will have to take the entire balance and liquidate it from the HSA in the year that they receive the inheritance. So that means they get taxed on the entire balance when they inherit the account. Even in an IRA, you get 10 years to do this. Now, the exception is your spouse. Let's say you pass away and you have an HSA. They can use the HSA as if it's their own for the rest of their lives. It's no problem. But anyone else, if they receive the HSA, they inherit it, they will pay income tax on the entire balance of the HSA in the year it's inherited. And they're kind of unique in that regard because a lot of other accounts do get some sort of favorable treatment if they're received an inheritance. Like you get time to make the withdrawals so that you can kind of spread out the tax liability, or maybe there's a step up in basis. Not so with the HSA. So if your heirs are just in high tax brackets, they have lots of money, know that it could be a considerable tax impact to them if you have a large HSA balance. So at this point, I kind of want to walk through how HSAs work through an example, and I've got one. My family and I have been covered on an HSA for 9 years now. We have zero regrets whatsoever, and we love our plan. Now, in our circumstance, my family, that's my wife and my 2 kids, are completely covered by my insurance through my employer. That's also where I have the HSA. Each year, my employer makes a contribution into my HSA just for me signing up. That amount is basically the difference in the premium cost between a PPO and the HDHP that I was talking about earlier. The amount that I save them on that premium, they actually just contribute to the HSA. That way, people who sign up for the PPO at my employer and HDHP folks are really getting the same benefit from the employer. Mine just goes into the HSA. Theirs goes toward their premium. Now, in addition to that, my employer gives me credit for doing things like running in like 5K races or exercising regularly or going to the dentist or getting regular checkups or making a commitment to eat healthy. Or if I smoked and I quit smoking, they give me money to do that. All sorts of healthy avenues through which they'll actually make contributions to the HSA on my behalf. So really, almost a third of the amount that I can contribute to an HSA each year is already done by my employer. Now, when we were first signing up for this 10 years ago, I was a little nervous for a couple of reasons. First off, even though we enjoyed good health, I was kind of scared about not having a bucket, if you will, to pay for those deductibles, because the deductible at the time was more than $2,000, which was a pretty good bit of money for a guy in his 30s with 2 kids at home. So it made me a little nervous, but the amount that we saved in premiums and the amount my employer contributed, it kind of covered that gap pretty quickly. So really by the end of the first year, I knew we could cover our deductibles. We still had some copay exposure, but we had a fully funded emergency fund in case we had some major medical event that we could cover that with in case we had to pay more than the deductible in insurance up to that out-of-pocket max. So sometime around a year and a half, we had enough money in the HSA to completely cover out-of-pocket max for an entire year, which was a big relief because at the end of the year, if the plan wasn't working for us or we had a change in our medical needs. I could just sign up for PPO, go back to the different insurance, and bring our deductibles back down, just pay the higher premium. It would make it easier from a cash flow perspective. Now, currently, we keep about $3,000 in cash in the HSA. We also have a fully funded emergency fund, and we invest the balance, which we've had going now for, 9 years. Some years we've contributed up to the max, some years we haven't because we weren't able to. But it just depends on your situation. Overall, it's peace of mind now knowing there's enough in the HSA to cover even a catastrophic medical event. We still thankfully enjoy good health, and as long as we do, we'll stick with the HDHP and the HSA. Now, with all that said, there was 1 year when the HSA did not pay off the HDHP. I actually had a cycling accident in 2016. I broke several bones on the left side of my face. It was pretty bad. There was surgery, there was an ambulance trip. Took a little while to recover, and there were a lot of medical bills. But we had enough money in the HSA to cover all those expenses because we'd been in the plan for a while. It was also a bit of a freak accident, so we just stayed in HDHP. We've been there for 9 years now, and again, like I said, we have no regrets. If you can, I recommend going back to your insurance company and seeing they have a history of your medical expenses. You can see how much they actually spent for you as an insured person in their company each year. That could kind of give you an idea of how much you'd be on the hook for if you signed up for an HDHP or HSA. That should give you a clearer picture of where you'd stand if you were covering yourself for more things, if you had a higher deductible, if you were in an HDHP, if you were up for an HSA, all those things. That way you'd know whether or not it actually be worthwhile for you. And that's a high-level summary of HSAs. We have lots of other videos about HSAs, which we'll link in the description below. If you found this video helpful, please click the like and subscribe buttons. It really helps our channel to grow. As always, we've got tons of other information on our website, martinmoney.com. There's also some stuff on the social channels, which are on your screen now. We are always so grateful for your interest in our videos and thankful for your time. God bless and take care.